The broadcast is now starting. All attendees are in listen-only mode.
Good Fed day, everybody. Everyone have their armor on, ready to do battle with our new Fed Chair, Powell. Give me a Y if you're ready. Hiya, Craig, Dan. Everyone doing okay? So we're looking at the dollar's been rallying into the Fed, right? Okay. I would use any further strength. I'm looking to fade dollar strength after the Fed. I'm not going to step in front. I don't like roulette. I'd rather react to the reaction. So looking at a couple levels in the dollar, halfway back's about 94-ish, which we almost tagged here. So one more run if it happens. 61.8's all the way back up at this reaction point here. My fib's not showing the 50%, but 61.8's here. You would certainly take out a lot of dollar shorts if you had a 61.8% retracement. But I still have conviction that before we get to new highs in the dollar, that we're going to see one more break. I still think this weekly breakout line is a magnet and it comes in around 92.50. So that's what I'm looking for. Everyone with me? So I'm not going to get in front of the Fed, but that's what I'd be looking for on that. So with that going on, in fact, the dollar might be the better fade, but the yen as well is on my radar. Okay, so I had a couple of intersecting speed lines, overthrow lines, return lines, whatever you want to call them. So we got here, we tagged it early in the week, and we're above it. RSI is really not confirming on the 4-hour. Somewhat diverging here. So, and as I look at the end here, it looks like we have 1 and 2, and maybe we get a third drive in the end up here. But my idea going in is the market thinks that we still have Janet Yellen and Ben Bernanke at the helm. I think Powell is going to be a different guy. That's what I forgot. DiMartino, the gal who wrote Fed Up, said that Powell's a different guy, and wants to get to normalization. So with the whole market thinking, yeah, they're going to hike rates, but it's going to be a dovish statement. I think that could be the surprise, is that it's not a dovish statement. And I just want to show you guys one more thing. It's the this just won't die, okay, Euro pound. And we're now threatening a pretty good breakout level here at 88.40, okay? Then you look at the daily, same thing. I think that's going to be an important level. You know, I've been really haven't given up on the scenario that there could actually be another high in Euro pound up here to complete this formation. So I'm showing you short term what the triggers are. Above 88.40, it's going to look pretty good, because if that happens over 88.40, you just do it arithmetically, call it 120, takes it to 89.60, take out these stops. From 89.60 to 86.20 is 340, and that's going to give you 93, which is right where this high is. So something else to keep an eye on, it's been my contention. I felt that way all through here too. What I'm saying right now, it's not that much different because I was looking for completion, but I learned this from Blake, false breakouts. You probably still have a lot of people hoping, this wasn't a false breakout, and you got lots of stops over this high, this high, this high, this high. And I'm just guessing, but I think that most people have a negative bias on euro pound. So I'm a stubborn guy, and when I see something, until it really proves me wrong, I still think it might be viable. And I don't know about you, I don't hear anyone talking about buying euro pound. So also, it's going to be a big day in bonds. So just want to show you. So probably yields also pop, but we're making lower highs here, right? Last week we talked about it here. We were 61.8 back here. Had a nice break. It's trying to retrace. Could it go to 305? Sure. It's a hawk. But right now it looks like we might be getting a failing rally. You know, it's my contention we're going to get something like this from wherever this peaks, which it may have already, and starts rolling over, and this low in yields will be violated. So if that's the case, we should be stalking yen for shorts as well. And that's my strategy, and how I plan or teach people to react to big numbers like this. And then don't forget that tomorrow we have the ECB. So it's kind of like you're out in the ocean and you're just getting pounded one wave after the other with the Fed and then the ECB. So maybe you just sit on the seashore and have a Corona with a lime. I bet Blake had one of those when he was in San Diego a week or so ago. Am I right?
Like 2 cases of Coronas. Corona Lights, though. I do Corona Light.
Okay. So. Well, I figured, you know?
Yeah. I actually like the taste of Corona Light versus Corona. I've been drinking Corona since I've been going to.
You were 12.
Kid. Yeah.
Since you were 12?
Pretty much. We have a place called Rocky Point close to us.
Oh yeah.
Puerto Penasco. So, but Coronas were as a once I was 18, and Coronas. But I'm a Corona Light fan actually. I prefer the taste of it actually. So.
Oh, okay. It's not a caloric thing.
No. It's just it's not as heavy. It's lighter. It's I
could drink more of them.
Yeah, and I mean, if I'm gonna drink Corona, versus like a heavier beer, it just depends what mood I'm in. But I am a Corona Light fan.
Thanks for the bonus last week. I went out and got a natty pack.
Oh, what?
A natty pack.
The a natty light.
Yeah.
Yeah, for those of you who don't know that if you do not live in the United States, Natural Light is probably the cheapest beer you can get next to Keystone Light, which is anyway.
Yeah,
something that a lot of college kids drink.
Yeah, I'm reliving my college days.
There you go. So,
but back then it was Boone's Farm apple wine.
Yeah, I don't know. I
remember Mad Dog 2020 gave me
the Mad Dog 2020. I remember the Mad Dog.
All right. So what are you doing in front of the Fed, buddy?
Nothing. I got out of my pound dollar long overnight at 40, 42. I think I got out of. I had a small euro dollar long, and I got out of that at like close to where it's at right now, like 50, 51 or something. And I actually have a cross rate on, and other than that, what I am looking at, and I just had it on my screen here. I'll point it out here. Let me grab the screen. Is I can't help but to look at silver. Silver is so damn strong now.
It is resilient.
It is. I mean, silver is like so strong. What the hell? What is this? I don't know what this is. I don't know why my fibs are all messed up like that. But you can see silver broke out. I played the breakout. What was it, last week, I guess? And
that was a good pip.
I sold, yeah, I sold some of it while we were on air here.
Yeah.
And then it dropped, and then I closed the rest of it out when we were down here because I'm like, okay, well, I'm a little scared of a reversal. But the fact of the matter is silver is still very strong. Now, I don't know, obviously, what's going to happen today following the Fed. I don't know if I want to buy the dollar weakness. I don't want to, sell dollar strength, but buy dollar strength. I have no idea. What we're going to have to watch today is we're going to have to watch the details of the statement and what Jerome Powell has to say.
Is there a press conference?
There is, and so
that's where it happens.
Yeah, and another risk, a big risk from yesterday, was when there is sources that said that it's possible that the Fed is going to make every meeting live, or I take that back. Every meeting's going to have a press conference.
Okay.
Every Fed meeting. Now, what that means is the potential for rate hikes, continuous rate hikes, is going to be viewed as hawkish, because if the Fed has a meeting, or has a press conference every single meeting, that means that every meeting is a live meeting. That's how the market's viewing it. So if the Fed announces that they are going to have a press conference after every meeting, these precious metals, which you have, silver is up above the 200-day moving average, it would slump. I would think gold would fail too, which gold is sitting on some pretty.
Has it ever been done before?
I don't know.
Yeah.
I don't know.
Greenspan Fed.
I
don't remember.
Like I have a hard time remembering back at the Greenspan days, because it was so long ago. God, but I just remember the Greenspan days. You'd be sitting there at a Fed meeting, you'd think there's going to be no movement, and then the Fed would hike or cut by basis points, and you'd be like, what the, and that's originally back in the 90s. That's what really stopped me from trading Fed days, because of the volatility. But I don't remember, because it was so long ago. I don't remember if they had, continuous live meetings. I don't think so, but I may be wrong. Somebody's gonna have to correct me, because it's been 20 years, literally 20 years. I mean, I was 1998, trading Fed days. They were so volatile, but I can't remember because remember, we didn't have, we just listened to CNBC. So there was no like squawk services. There was no, we couldn't, unless CNBC was broadcasting, but I can't remember if there were actual live meetings or not. But anyway, that is one thing that the market is looking at, because if the Fed says, hey, we're going to have a press conference every meeting, they are interpreting that as being potentially hawkish. Now, also, we got to look at the dot plots. We are one Fed governor away from adjusting dot plots to making the market believe that there's 4 rate hikes coming this year versus 3. So that's another detail that the market will be looking at. And I'm like you. I don't think that it makes sense to get ahead of this moment in time and try to anticipate what you're going to do here. But I think what we can do is we can identify, certain charts and see where the levels are at, and see where the dollar is a breakout and where it's not. So, I look at the euro dollar, it's still constructive for this inverted head and shoulder pattern. Any which way you slice it, the euro is really pulled back, very minor. Oops, let me adjust this.
Well, when I interviewed Daniela DiMartino, she worked for Fisher at the Fed, and she wrote that book, Fed Up. And that's one of the questions I asked her. She said, yes, this is a different Fed. Powell is different than Yellen
Yeah.
and Bernanke. So, you know.
Sure. They're all different Fed governors. And, now Powell, of all the Fed choices or choices for Fed chair, he's probably the closest to Yellen that we were going to get, but he's still, his own Fed governor. He's going to try to leave his own mark, and he's going to do what he thinks is right. Obviously with the consent of the governing board, what he thinks is right for the U.S. economy. But you're right. He is his own.
But your Euro chart, I know it's a Fed day, but to me, Blake, it looks constructive. Like, during this dollar bounce, all it's done is move sideways, corrected, being overbought by not giving up hardly any price.
Right. And remember, the euro is, as you use the analogy of waves crashing, I mean, we do have the ECB tomorrow too. So
yeah.
which the market is expecting, the ECB to potentially start talking about an exit. So that the euro is going to be a little bit more tricky than other currencies, but if you look at like the euro dollar, it looks fairly firm here. The pound looks weak. I mean, the pound, we hit the 618, and despite you look at CPI overnight, CPI came in line, producer prices came in a little hotter, and we do have PPI here in the US as well, which it comes out in about 14 minutes, but the pound still slumped. And I was looking for an inverted head and shoulder pattern if we stayed above this 133.40, but we slumped through it. I'm like, okay, I got to get out. It doesn't mean that we can't go higher, but the pound is not acting well. You know what I mean? It's just not. It's not performing very well. But you look at other currencies like, hey, the Aussie, we held support here. The Kiwi actually looks pretty strong. This looks a lot like the euro dollar, which, we're holding the 38% retracement thus far. But, hey, if the dollar's weak following the Fed, the Kiwi, this could be a real big move higher. The dollar Canadian, we can end up rejecting this key resistance here, but it's obviously NAFTA headlines is what really is driving the dollar Canadian right now. But if the dollar weakens, the dollar Canadian can come right back down to 129. You have the Swissy that's trying to break out, but this is a currency pair. If we have a bullish US dollar outcome today, if we do, the dollar Swiss could really power higher here because we have this bull flag pattern setting up. The US dollar, Norwegian krona, Swedish krona, they're just kind of sitting there. They're a little stronger versus the dollar, so the dollar's a little weaker against the Nordic currencies, but they're pretty much just waiting for what's going to happen with the Fed and the ECB. The U.S. dollar Mexican peso continues to grind higher. I mean, it looks bullish. This is one of those charts that keeps me very constructive for the U.S. dollar Canadian. Now, the DSI for the peso is at 10, which is a risk because it is so weak. Sentiment is so weak for the peso, which could obviously turn at any moment. So that's something that we have to pay attention to. I'm not interested in shorting the dollar peso yet, but it's just something that in the event that there is a NAFTA deal gets put together, then the U.S. dollar Mexican peso would be probably my number one short, U.S. dollar Canadian and dollar peso. But I would really keep an eye on this peso here. Let's see what else. The dollar index, we have a possible bear flag setting up. So again, we have to wait for the Fed here, but possible bear flag. And the dollar yen, still looking strong. We could set up a Gartley pattern here, but as long as we remain above like this 110 level, it's hard to fade it. I tried shorting this unsuccessfully. I did it. I made really good money last week shorting the dollar yen here. I lost a little bit as I tried to short as we were coming up against the 618. So, but now it looks very constructive, but yeah, it's pulling back just a little bit. And that's pretty much it, Dale. I mean, again, I'm really more or less focused on what the Fed, does the Fed, does the Fed go every meeting with a press conference? If so, that would be viewed as hawkish. And does the Fed adjust the dots a little bit, the dot plots a little bit? And if they don't do either one of those, then the risk is of a euro dollar that's going to go higher ahead of the ECB tomorrow. And then and as you rightly pointed out, the pullback for the euro has been very minor. I mean, we haven't even pulled back 38%. And here, let me get rid of this other fib level so you can just kind of see it a little bit clearer here. Let me get rid of this one too.
Yeah, Ziggy's right. We used to watch Alan Greenspan's briefcase.
Yeah,
and
so
it
was
was
the
real
briefcase
full.
indicator.
Yeah.
Yeah, the briefcase indicator. But I remember the briefcase indicator, obviously. I mean, CNBC really glorified that. If it was packed and papers were falling out of it, then you knew that we were going to get some activity. That was basically the briefcase indicator. I remember that. But as I was pointing out here on the euro, the pullback has been very minor. If you are out there shorting the euro dollar, you're probably a little frustrated that just from the idea that it hasn't pulled back much. But like I said, I'm more interested in post FOMC versus pre FOMC. Right now, I think the best thing for us as traders to do is identify where the key support and resistance levels are and cue off of those following the FOMC. And other than that, I mean, let's say, I guess here's one other thing I want to say is I want to go back to precious metals, because if the dollar does weaken, let's say the dollar does weaken, and let's say gold and silver continue to strengthen, silver looks really strong. Gold is still holding this. Here, let me zoom out a little bit. You can really see this here. Okay, and I'm going to get rid of this circle. So gold broke the 200-day moving average. It broke through 1300 and it started to fall. Right here. I would think right at this moment in time, as we broke through these lows, anybody who was long got out, or at least got out of their longs, and then shorts entered the market, because you see this 5-month consolidation. The market probably started shorting gold. Now, the fact of the matter is gold has not fallen that much. Now, I'm not saying that it can't fall, because if the dollar strengthens, then the gold market's going to finally break through this support, and we're probably heading towards like 1240, right? That's possible. But in the event that the dollar weakens and silver breaks out, because silver looks so bullish, if gold breaks back above 1301, you gotta 1301 to 1305, you got to be looking at gold is going higher, because of the limited follow through that it's had to the downside. And one of the other things that I've got to say about gold and silver is silver is holding up so well. That means the silver gold ratio how do I do silver gold? Silver gold. I'm trying to do the silver gold ratio. Let me see if I can
Yeah,
You want
Steve
the silver,
Steve
you
showed
want,
it. Yeah.
Hey,
you
what
want the
is it,
sil-
Steve?
you want the gold-silver ratio or the
Yeah.
silver-gold ratio?
Gold silver.
Then you know, XAU USD. No, XAU USD.
Oh, okay. XAU USD.
And now go to the a little bit more to the right. Do you see the symbols? Yeah, just press the dividing symbol. That one, yeah.
Oh,
And now
okay.
XAG USD.
Got it. Okay.
Yeah,
So this would be the gold-silver ratio, which is
Yes.
breaking down. And then you could do it the other way. That's right. I forgot how to do that. It's been so long since I've done it.
it's a big breakdown.
This is, and so when you have this breaking lower or the silver gold ratio breaking higher, it tends to be bullish for precious metals. Tends to be, and so that's something that
Blake,
should be paid attention to. Yeah.
If you zoom out so you can see from 2011, you will see that there is a very nice ascending wedge. We are getting close to the ascending wedge's support.
Like this.
Yes.
Something like that. Yeah.
Yes.
Regardless, it's a pretty key trend line. Yeah. So, you know, if this breaks down, that would be in this case bullish.
Yeah.
Birthday
boy wants confirmation.
Right. Speaking of which, good morning, Steve. How are you?
Good morning, Blake. I'm good.
How have you been? Were you confirmed several times in your as a child?
Hey, Steve, I passed you over the charts.
Got it, mate.
You have control over them now. Now, one of the today, I mean, the price action has been extremely slow, and what I urge everybody to do is really get in front of your charts and look at your charts objectively and say, okay, if the euro gets here, it's bullish. The euro gets here, it's bearish. And do that with all your pairs and try to figure out where you specifically are going to turn bullish or bearish these currencies, and try not to make an assumption something's going to happen. You know, try to go into this Fed meeting like, you know, unbiased as possible, because I think that's the approach you have to take today. And also, you know, Dale, you've got a great interview coming up. Mark Noonan, I have a lot of respect for him. He's a great analyst.
We'll cover the gamut.
Yeah. So I'm excited to listen to what Mark has to say, because things are going to be slow. I mean, things are going to be slow till 2 o'clock Eastern. So just keep that in mind for all of you guys that are involved in the markets.
It's a good time for everyone listening to subscribe to ForexAnalytix and
we do have PPI coming in 2 minutes. So
okay.
I doubt it's going to move the market ahead of the Fed, as you said, Blake. But regardless, it is quite important data, because PPI always, in a sense, leads CPI, and we know very well how important inflation in general is for the central bank's decisions, for any central bank's decisions.
Right. So good luck, everybody, today during the Fed. I'll see you guys in the chat room. For those of you that ForexAnalytix subscribers, I'll be there for the Fed meeting. And don't forget about Forest Park FX, and I'm sure you'll mention it after the PPI. So talk to you guys soon.
GL.
Thank you, Blake. See you later.
Thanks, guys.
See you.
Yeah, Steve, I even talk in, like, you know, text language now. GL.
GL, yeah.
OMG.
OMG, the Fed hiked 50 BPS. No, I'm kidding.
Yeah. LMAO.
Yeah, in this case, actually, that would be LMAO for sure.
Yeah.
Yeah, let's have a look. In less than a minute, we have PPI data. Stelio, if I'm not mistaken, the market is expecting 0.3 month on month.
Yes, up from 0.1 from last reading, which makes it's about 2.8% year on year.
Yeah, which is quite strong actually.
It's interesting that UK PPI beat by quite a lot today. But okay, let's have a look. It's coming
out. Let's see if the same thing is going to happen here.
Oh, that's strong. 0.5. 0.5. Everything is green, so this is strong.
Yeah, that's actually more than strong. Yeah. So 0.5% month on month, which is 3.1% year on year versus expected 2.8. That's actually
that's hot.
That's hot.
The weird thing is that the
market. The dollar rallying on that number?
Yeah. Not even.
I have the answer for you, Dale. The dollar isn't rallying ahead of following the data, simply because I think that nobody is willing to commit to anything ahead of the Fed's decision for obvious reasons, right? Because PPI on its own is not going to be enough to hold the dollar in case for some reason we had or we saw or we see tonight more of a dovish Fed in comparison to expectations. That's why. So as I said before the data, I would be really surprised no matter what happened if we actually did see a big reaction. But I do think that if we're not just speaking about like the following hours, I do think that the Fed cannot stop ignoring the fact that the last of the excuses they had about keeping a very loose monetary policy, which is inflation in general, seems to be ticking higher, and with everything else like employment, etc., being where it should be, even better than expected, already for multiple months. I do think that this gives more credibility to a hawkish path from this point on. Anyhow, I don't think that the Fed can ignore that. Any other comments, Telio?
Oh, I agree with you. I'm actually surprised that not even the metals got smashed. Usually, strong US numbers, they get it on the head, right? Usually, not even a little bit, which is disappointing.
Yeah.
I don't mind because
actually,
I'm long silver, but
yeah, gold is unchanged on the day. Silver is actually on the highs, currently testing a soft resistance level here, a break above. Actually, targets 1733 next. So you're right. I mean, the metals do look good. Palladium is the only metal that was under quite severe pressure today, but palladium has totally different characteristics. So yeah, absolutely. And I'm looking forward to seeing what the Fed is going to deliver. But in all honesty, as I said, I'm still long, Euro USD. That's a fact. And I, from a technical perspective, I still believe that the chances for Euro jumping somewhat higher from here are decent. I actually even bought myself a little bit of cable yesterday, 1/4 position cable, because I wanted to have a little bit more exposure short USD, and I have no problem doing that ahead of announcements or whatever, because I'm just looking at it from a technical perspective. But obviously, the chances that we see some kind of a hawkish announcement do increase. Anyhow, I think more or less we know if this scenario fails. Simply, I'm viewing, for example, in the Euro USD, I'm viewing this consolidation as a bull flag so far. I would like to see one more push to the upside. More or less the same deal with cable. Cable, I see this move lower perhaps as a B in an ABC, so I would like to see a move higher from here. Now, if today we see something completely opposite to that, I'm obviously going to be closing those positions. Euro USD, I'll close it at break even. I might lose some in cable. Now, other than that, I really can't predict obviously what the Fed is going to do. I can only have a look at the charts. And as I said, even if we look at the DXY, let me go there. Even if I look at the DXY, so far nothing has changed. I mean, I do still view this little consolidation, the DXY, perhaps as a consolidation that will lead to one more push lower. I would ideally want to see 92.50 to 92.70 being tested. I am viewing these moves as corrective, but I don't think they're over. That's the only thing. Now, if this actually plays out, I mean, if we do see a push lower in the dollar for one way or the other, I will be booking profits, and I will start actively looking for opportunities to be long the dollar once again. As I had said, that was my plan since the very beginning. My plan is to actually end up buying the dollar for at least one more strong move to the upside, simply because if we go back to the DXY, you'll see that, you know, we found a high in the dollar at the very, very first days of 2017, and we've moved strongly lower since, you know, February of this year. And I do think that there is, you know, quite a chance that, you know, we're going to see one more push to the upside before actually resuming lower. Long term, I would think that you know, the dollar should keep depreciating, but I don't think we're there yet. Okay, so it's very important to separate in time frames and know exactly what your plan is, you know, for each of them. Now, having to do with USD yen, nothing has changed since yesterday. I was saying that for me, 110.80 is quite an important level. I do think that, you know, there's a good chance that we're going to see a resumption lower, but for that to happen, I would want that level to hold. Okay, and then I would be looking for another test of 108. Now, if we do see a break above there, especially daily close, I will be, you know, looking for a totally different kind of technical picture. Anyhow, I don't have a commitment in the USD yen. Just having a look at it, I was showing yesterday specifically that I think that multiple of the yen pairs are actually well positioned for more weakness ahead, and you know, nothing has really changed having to do with that. My favorite most probably is my favorites actually are probably CAD yen. You can see it here. So we had an impulsive move lower, which actually produced a breakout of this triangle, right? This ascending wedge. I think the move was impulsive. Then we had a recovery, which was channeled, and now we've broken below the channel again, and we're consolidating. I would want to see a resumption to the downside. I like CAD yen quite a lot for a resumption lower, and you know, pound yen is also one that I think looks good. You can see it here. It has stalled again on this trend line support, which is now broken, acted already once as the resistance. Perhaps it's going to act again as resistance as long as we remain below it. I would view favorably a rejection and a resumption to the downside. So pound yen and CAD yen probably preferred shorts. Now Aussie yen is also not looking bad at all. It's still holding this channel. You can see it here. You can call it a bear flag or whatever. I think that as long as it does, a rejection can lead to a resumption lower, in which case I would be looking for much lower levels. You can see it here. If I zoom out, we had this ascending formation. Now, if I mark it like this, you can understand that you can clearly interpret it as corrective, breaking lower. This looks like corrective as well. Why not, you know, getting one more move to the downside from there? Okay. Kiwi yen doesn't look that good. I said that, you know, between the two of them, I would definitely go with the Aussie yen having to do with weakness. I just want to remind that. Now, nothing much has changed with indices. I'm still long. I took profits the day before yesterday at night on my long in the S&P. I can show you on the 4-hour chart why I did that actually, because potentially I see 5 waves up. Perhaps the 5th wave might even prove to be an ascending wedge, right? Something like this. We're also, if I zoom out, you can see that this is also horizontal support resistance area. So I wouldn't be surprised if we saw a rejection from here. That's why I took half profits from my long, which I took at 2,720 point some change. So I do think that we might see a pullback from here. We're just above the 161.8 as well. But, you know, having said that, I do still see favorably. We have RSI divergence as well, but I do still see favorably more upside for indices, even if we first get a pullback, right? Having to do with the potential for moves lower, I preferred, and I actually took 1/4 of a position short the DAX and 1/4 of a position short the FTSE yesterday. My thesis here is that perhaps we're seeing some kind of moves like this, and perhaps we have one more leg lower. This is the DAX on the 4-hour chart, and this is the FTSE on the 4-hour chart. You can see, it's an equivalent situation, right? So why not one more leg to the downside? So in essence, I've hedged the other half of my S&P along by taking 1/4 from each of these indices short. Now, I do view now, if we look at them on the daily chart, I still view the potential one more leg lower in the FTSE, here it is, and on the DAX as corrective. So I will be looking to book profits if we get one more leg to the downside, and I might even actually be looking to buy some down there. At the very least, I will unhedge this way my half of my S&P long that I have. Okay, now having to do with Nasdaq. Nasdaq is pushing the all-time highs once again. It's still looking quite decently. This is the Nikkei testing 23,000 resistance once again, and this is the IWM. The Russell looks good. As we were showing yesterday, why not a retest of this confluence? Sorry, a test of this confluence of resistances, which is the 161.8 and the ascending channels resistance at 171.8. I think that would be a good area to be looking for a reaction lower. Until then, it still looks good, but at whichever point it does fail and pushes lower, I think that this broken now, you can see there's a broken triangle. I mean, between this trend line that I switched to blue and this one here, this was a nice triangular consolidation here, a break higher. Why not, if at some point it fails, come down to retest this broken triangle's resistance as support? As long as it stays above there, definitely keeps looking quite good and obviously bullish. I mean, we are obliged to respect the trend in such a case, right? This is a trend that has been going on for years in all the indices. Okay, so let me open the question box and see what kind of questions we have. Today we have a very good interview with Mark Newton. I think you should stick around for that.
Steve, can we start with Treasuries if possible, because they're moving quite big?
Absolutely. There we go. Okay, Treasuries. Here are the Treasuries and here are the bonds. So let's start with Treasuries.
Thank you, mate.
Here is the 10-year, the ZN. ZN is coiling still above this descending.
Yeah, I wouldn't call that getting smashed, Dina.
No,
really?
Yeah,
getting smashed. I don't think
Initially, they got sold, but I think it looks like it's.
Well, I mean,
no.
What?
Yeah, I think
5 pips, 5 ticks.
Yeah, they're consolidating. They're still consolidating above this descending wedge, and there is always the potential that we're going to see one more thrust higher from here. I mean, I like it from a technical perspective. I think that the reward to risk ratio is amazing. Is amazing. I mean, you know if you're going to be wrong, it. You have to risk very little to actually to actually see one more push to the upside, which can even bring us to 122.5 roughly, right? So I do think that the reward to risk ratio is still looking very good here for one more move to the upside. I think that this move that we saw, a couple of weeks ago, it was very strong. It was.
What kind of high is that on the RSI?
It's a confirmed high because we penetrated the 70 easily. I mean, we saw a move. We saw a 2.5% move within what was it, like 5-6 trading days.
You're so cheapable.
And I think that the move lower, isn't convincing yet that it's like a resumption of the previous move. I would really want to see one more push to the upside. And, you know, the Fed today can surprise and actually produce something like that. Now, if we have a look at this from the perspective of yields, you will see an equivalent picture. First of all, yields came down very aggressively. They retested this inverted head and shoulders neckline. But now if you see the move higher in the yields is stalling once again. So why not, you know, equivalent situation here, inverse obviously, why not seeing one more push lower from here, right? For the yields, something like that. So I do think that, you know, it looks like something that can potentially happen today. I mean, technically speaking, you know, I have to respect this possibility. Now, if we have a look at the Bund, you can see that the situation with the Bund is, you know, quite complex as well. Overall, if you zoom out and you look at the big picture, this looks like a very big consolidation within a very, very, very strong uptrend. I mean, look at this uptrend, right? Multi-year uptrend since before the financial crisis, the Great Recession, which actually peaked at the summer of 2016. But since then, we've been seeing a move that's slowly drifting lower, but definitely nothing impulsive here. So oppositely with Treasuries, Bunds look a lot more corrective. I mean, the move lower in Bunds looks even more corrective than the one in Treasuries. So I would be quite careful here as long as we remain within this formation. At some point, I don't know if it's going to be like a re-emergence of the Eurozone jitters. You know, this can come because something is happening in Italy or in the whole Eurozone or in some other country, or because, let's say, the global economy is going again in a recession and that, you know, resurfaces again whatever problems there are in the Eurozone. But one thing is for sure, you know, from a technical perspective, I can't really advocate somehow a big breakdown in the Bund. I mean, I believe that might have been the case when we were breaking down here, but once we came down, we retested this trend line once again, and we saw the move that we saw. You know, I got even more certain that this is probably just a corrective move. So at some point, from a technical perspective, I would really be looking for a break higher and a resumption higher for the bonds. We're currently anyhow in the middle of this. As you see, due to Italy, we had like a huge spike higher, like within 10 days, we had a huge move to the upside. We're now retracing, we've retraced like 78% of this move, but, you know, still there are no significant levels broken. I mean, the bunds remain within this large consolidation. So I would really not commit to anything here in the medium to long term, right? I think we need to remain patient. Treasuries getting smashed. Yeah, we said about that. Copper, nothing has changed with copper. I mean, copper did break out. The fact that it consolidates after a breakdown, because this is more or less a consolidation, I think, you know, adds to the possibility that this is, you know, this is a proper breakout. And after a little bit of a consolidation, why not resume to the upside? I think that the next upside target is the 3.42. That's the 127% extension of the corrective move lower. So I do believe that copper sooner or later should push higher once again. Hi, I have a question about Euro USD. If we label wave 1, 117.22 and wave 2 complex correction, 116.52 and wave 3, then we have a pullback which invalidates the entire count at 117.27. Now, can we say we are in an ABC correction, that wave A is done and wave B is unfolding? Now I have to reread this and start drawing on the chart. I'll tell you what, let's have a look to answer your question, you know, quite fast, because I have to go back to what you wrote and let me open the ForexAnalytix platform. Let me bring it here, I mean, because I always have it open on another tab. Okay, there we go. And let's give you a freebie. Let's see what Greg is looking on the 4-hour chart. Okay. So Greg still thinks that this is a 4-hour chart in a corrective move lower, right? So this is a B in an ABC, A, B, C. Now, if you look at it on the daily chart, he still has 2 counts. You can see both of them here. According to one of them, this was a high. According to another one, there is one more push to the upside left before actually EURUSD can roll over, and move to the downside. Personally, since I believe in longer-term weakness in the Euro USD, I do think that this wave count is actually quite possible as well. Anyhow, the 4-hour chart shows that more upside should be coming, perhaps from a little bit lower than we currently are. Okay, so according to this, obviously such a count would get confirmed if we saw some initial dollar strength today, and then we saw some more dollar weakness, and then we got a push towards the 119, 120 area. Regardless, I think 118.50 and above would probably satisfy enough of a correction to be looking higher. Okay. I hope that answered your question.
Excellent analysis.
Dan is saying, Dale asked Steve for Euro Pound, because I keep saying that Euro Pound is like...
We're on the opposite side. Yeah, he's a troublemaker. He's a troublemaker, that Dan Norbert.
Yeah, a little break higher in the Euro Pound, but still within this descending channel. Personally, as I've said multiple times, I wouldn't be doing anything with it.
See, Dan, I could have told you what Steve was going to say.
Oh yeah, absolutely. You could.
We should tape. We should just record our review on Euro Pound, and every time we talk about it, huh?
At some point, actually, Euro Pound is obviously bound to break out, and when it does, after such a prolonged
there's a lot of compression building up here.
Oh yeah, there's gonna
like
be
a Ferrari, like Stelios's Ferrari that never left the garage, but he would rev it up in this garage.
Speaking of which, have you seen the video with the Stelio? Have you seen the video with the Bugatti 400 kilometers to zero again in 40 something seconds?
Yes, that's almost as quick as you and your Alfa Romeo, man.
Okay, so that's.
I have a green Gremlin that I'll race you in, Steve.
You have, right?
Gremlin? Oh, it's a great car. I traded my Pinto in for a Gremlin.
Oh, I know Pintos, actually.
Yeah, they're nice.
Okay.
What about crude, man? What about crude?
Crude, I think that, let's have a look at it and you'll see that I think that crude is,
there we go. I think that first bounce.
I think, me too. I think that this bounce that we're seeing here as well, this one is corrective. Yeah, it's extremely weak. I mean, let's go down to the 4-hour chart and see it from here. I think it's going to be more than obvious on the 4-hour chart. There it is. Do you see?
Yeah, like a flag. And we have 2 drives. Yeah, down there.
Yeah, this is some kind of a wedge.
62.
This is some kind of a,
yeah,
this is some kind of a wedge, and I think it looks very weak, and I think that the chances that it's going to fail and push lower. Even RSI has now done enough. It came back to 60, which is a nice resistance, for a bear market. And don't forget, this is a bear market because we're talking about a 4-hour chart, right? So I'm not losing focus here. Obviously, crude has been on a very strong uptrend, but if we look at short-term time frames, this move in the short term was more or less impulsive here. I mean, we said since the beginning that there is more downside coming. I was actually hoping for a rebound towards the 69 area. It didn't go all the way to that. It resumed lower, and I do still think from seeing this that there is more downside for crude before this corrective move can be over. So I do think that we should be still looking for more weakness ahead. Okay. Obviously, if we see some kind of a hawkish Fed today, definitely this is one of the instruments that's going to be helped in playing out as the technicals point, with which they point to further weakness. Now, having to do with the euro yen, we've had a V-shaped recovery here. There's no question about it, and we've also said, it's now not anymore on my chart, but we've already said that this move lower and this move lower were actually equal, right? So this move was equal to that leg. This leg was equal to that leg, and that troubles me a little bit, having to do with the bearish scenario. I have to say that. I have to admit that this troubles me a little bit in being outright bearish. Regardless, though, I do think that as long as we remain below 131.50, there is a decent chance that more weakness lies ahead. Okay. But I'm not committed to that. I don't have a position. I was short the euro yen. I took profits. That was a nice trade. I'm not looking to reestablish my short yet. If I am to short one of the yen pairs, as I said, it's either going to be the pound yen or the CAD yen. I think I'd rather go with one of those than the euro yen. So Dale, is Mark with us?
Not yet. I'm
Okay.
trying to get a hold of him.
Okay.
I'll let you know. We got 4 minutes.
Ziggy says, and I saw that before actually, not that it really matters, but Trump is trashing oil on Twitter this morning. Yeah, I saw his comments about the OPEC, right? That they're manipulating crude, and crude is much higher than it should have been, etc., etc. Personally, I couldn't care less. I mean, I don't think that Trump or anybody else can actually move, can really move crude. I mean, crude has its own dynamics. We haven't seen a reaction to his comments, and I don't think we're going to see a reaction to his comments because it's just purely, speculative commentary. I don't think it will do anything to the pair. Now, we had a question about the USD Turkish lira. If you remember, I cautioned here that the USD Turkish lira, it is in a corrective move lower, and it can still move lower from here. I mean, there is likely an event already happening. I mean, likely we've been breaking out of a bull flag here, but you can never be certain with corrective formations. This might not be a bull flag, it might be a triangle or something else, in which case we might stay in corrective mode for longer. But in any case, I would really be expecting either from here or from a little bit lower the uptrend to resume. I don't think that the Turkish Central Bank has done enough, and definitely the prospect of Erdogan staying more in power is something that isn't helping and won't be helping the Turkish lira. Okay, so that is something to keep in mind. Now, let's have a look at more of these exotics. One of them is USD ruble. USD ruble might be breaking out of a triangle. Let's see what happens today, but I'm definitely monitoring this as such a probable event. But the triangle might be something different or whatever. Still, I think for the time being it looks better for one more thrust to the upside than the opposite, right? USD ZAR is also pulling back. I said yesterday that we were testing resistances. We were about to test actually resistances. This is the confluence of the 61.8 and horizontal support resistance area at 1340. We actually tagged that today, and we seem to be pulling back from there. So let's see what kind of a pullback we'll have. But I think that this is definitely an appealing short from this point on, even if we end up having a corrective pullback. Did you get Mark, Dale? Because I hear you.
Mark's here.
Okay,
ready to go.
Let's go.
Great
then.
job,
I'm looking forward to hearing what he has to say, especially ahead of the Fed.
Yeah, I'm a fan too.
I'm a big fan. Thanks, Steve, for the analysis. That was really great.
Okay, thank you, guys.
Okay, so Mark, you have some fans in here. I don't know where you live, but on a hot day, it's great to have fans. I'm in the high desert. So, how are you, buddy? Just passed you the baton. Thank you for coming again, Mark. I can hear you,
me
bro.
now?
Yeah, Mark. How are you today?
Wonderful. Thanks for having me, Dale. I appreciate it.
Okay, so let's start with what's happening today before we get to the charts, Mark. Your expectations for the Fed, and follow-up question: will Powell be different than Yellen and Bernanke? And do you see this as a different Fed than what we're used to, with the market always believing they have the Bernanke-Yellen put?
Yeah, I mean, I think it is a little bit of a different Fed. I think you can argue that. The expectations obviously are for a quarter-point hike, and many are just wondering about forward guidance. The data today came in much hotter, arguably, than expected, and that's going to be a continued issue. The fact that you're starting to see data get incrementally better and better, but yet there's still real issues with regards to productivity and GDP, which is still very low, and nobody seems to have the answer to that outside of just thinking that we need to address things like entitlements and other things to really get GDP growth up to near 4%. So my view, honestly, is that the Fed is hiking into a fragile recovery. I don't.
1937, Mark? Isn't that what they did in 37?
Yeah, I mean, I think, well, the interesting time you mentioned the 30s, I mean, it's very similar to this time in some ways, where we had, the bear market peak in 29 to sell off into 32, huge debacle, and, the subsequent decade was spent with the banks trying to, buy up assets, and then of course they were villainized, and that hurt Roosevelt, and they had to shut down the banks, and then there grew this disparity. Wall Street rebounded from 32 to 37, but the broader economy went through a very difficult time. And I think that is not unlike what we've seen since 08, 09, where the markets rallied, but yet the economy just sort of muddles along, and we're gaining some traction a little bit now, arguably, but still a lot of issues. Some of them might be demographic, where more people are leaving the workforce than any time in history. More people retired now than working, and so that could be part of the reason why the number of people in the workforce has dropped off. But it's just, it remains an economy that you can still argue on both sides. There are people that are very frustrated over the last 10 years with regards to the regulation. Anybody that works in the financial space, and that's starting to be addressed, I think, slowly but surely. But it's still a tough economy. To argue that it's red hot and everybody's working and everybody's making money, the sentiment certainly doesn't seem that way. It seems like we're in the latter stages of this economic cycle, but yet nobody's really happy with the pace of growth. And so we're at the second longest economic expansion ever, and pressing on longest market rally almost in all time, but yet people are still having a lot of difficulty making money.
Yeah, let me, that puts the bonds in a very interesting position. I see your yield chart up here, Mark. I've been saying that the most embraced market thesis on the street, in the cosmos, is that the bonds are in a bear market. And I look at the yield chart here, and I even go real macro on a monthly, and maybe people have it wrong again about the bonds. What's your outlook here?
I think it's going to be difficult for bonds to sell off too meaningfully, meaning yields rise dramatically over 312. I don't see that happening in the next couple of months. I see there being a greater likelihood of us potentially pulling back a little bit in yields. I think sentiment has been very negative on Treasuries, and historically that's marked pretty good buying opportunities for those seeking to buy Treasuries. So I don't disagree that momentum and everything seems to have shifted, and we seem to have potentially carved out a low in yields in 2012 and 2016. But I just don't see how yields can make meaningful progress higher when everybody's betting that they need to, and that's going to happen. And I think that's where we are now.
Well, I mean, if the Fed
sentiment is more bearish this year than it was last year, right? So we still have close to minus 400,000 short Treasuries, and last year that marked a peak in yields from what 260 down to 2%, and so now we're up. We've gotten TD sell setups on yields similar to what we had in 14 and 06, and so these do tend to be important. I think we'll see if we can make much progress. Yields seem to have stalled out right near this trend in the last week. They've been very lackluster. We continue to try to make gains, but yet they're we're seeing Treasury yields into the close, yields pull back to ride flat. And that's really hurt the financials, I think, and that's a key part of the stock market.
Yeah, but you look at things like the XLF, and they've already retested Feb lows quite a few times. To me, it looks like if we do have a market correction, which I think might start this week, that financials will lead the way by taking out its February low first, because it's already tested it a few times.
Yeah, the XLF has been in pretty, and this is a chart just of the XLF and showing what this, and so we've been unable to really show very good signs of progress here. When you look at relative charts, they've been even worse in terms of how this looks, and I think that's important to point out that financials, relatively speaking, peaked out in February, and this is a longer term uptrend for the last 2 years of financials versus the S&P. So we've seen a 2-year trend line break of financials and being at their 15% or so, a very important, piece of the puzzle to not have working at a time when people are very optimistic on the market.
Do you think it's related
technology
to
sales? So go ahead.
Do you think it's related, Mark, to all the fears about Deutsche Bank, that it possibly could be a contagion and eventually, and that's why people are worried about U.S. banks too?
I wish I had the answer as to why exactly it's happening. Sure, that's
or the flattening of the yield curve. Could that be it?
Yeah, that's also a problem. I think I look at pure technicals. I look at the here and now and not try to gain too much conviction on why I think something's happening, because
I understand.
When the charts change, you have to look at that, and that's simply, from a DeMark perspective, we got sells on a relative basis and financials back the latter part of the year, and we're still seeing some deterioration. So tech and financials are 40% of the market. If those areas aren't going to work, and tech obviously has worked quite well, but now you're seeing a stalling out in technology just in the last few weeks, and so that's a little bit of a concern when you have the two big generals of the market, which
how about
everybody's looking to lead us higher.
All right, so you're talking about generals. What about King Dollar? So this was a very impressive dollar rally. Cleaned out a lot of Euro bulls from over the 120 level. Where are you at on the dollar? Was 95 just a short-term peak, and we get a little pullback, and then we're going to higher levels? Do you think this could turn into much more of a dollar rally than the market was expecting even a month ago?
I think in the near term that it's still likely that the dollar probably pulls back in the months ahead. I remain sort of a dollar bear over the next 5 or 6 years. Whether on an intermediate term basis, if any dollar pullback in the next couple months provides a chance to, for those to still stay long the dollar, I don't know that. I think that we have seen some intermediate term progress, obviously, in the dollar, which happened back in April. This is the Bloomberg dollar index, which has a much lesser exposure versus the euro, but you're seeing, we're seeing evidence of counter trend exhaustion here. We haven't even gotten up to October highs. So I'm thinking the dollar is in the process of stalling out, and seasonality bodes well for dollar weakness, typically starting in June through October, typically. So I'm thinking the dollar is going to start to pull back, and that could provide a chance for those to get long the metals. I think euro and pound sterling have been attempting to bottom out slowly but surely, but you know, I think if you look at the dollar longer-term charts going back over the last few years, you know, it's certainly been a decent rally that we've had in April. It caught a lot of people off guard and was important to pay attention to. I would argue that, you know, in the short run, that this correction. Yeah, and that's the whole thing. I mean, that's the longer term chart. When you pull it up, you know, to put things in perspective. Let's see if I can.
It looks pretty good.
So, you know, this in the near term, you look at the longer term path, and it doesn't give a lot of conviction for, you know. Right now, we're basically neutral over the last few years, right? So we have made progress throughout, up in 15, and it's just choppy. I think for the bears to gain conviction, you need to get under the lows that we saw earlier this year, which would bring about a huge decline. And I don't know that that's going to happen right away. I think you see a minor pullback over the next few months. It likely provides, you know, a chance for maybe further rally a little bit, but I don't have a lot of conviction. I was, you know, you turned bullish in April, and it's right to be long. Now I think we're stalling out, and actually I see a sell-off in the dollar. So I think euro and sterling likely rally. And
you like the metals as well in here, because
I mean, yeah, the base metals have started to turn out. The precious metals, it's been very frustrating for bulls of silver and gold. We saw a little bit of action in silver last week, but yet the you know, the charts in gold have been pretty frustrating to try to call for any meaningful type breakout. We've stalled out, and we're sort of in this choppy range-bound pattern near the longer-term trend from, you know, right near the election. I would say, though, that the sentiment has gotten pretty negative now on gold. And so, you know, when I look at this this area, you know, technically it doesn't make me excited to buy gold just yet here. I think that, you know, this could be a corrective pattern that you end up getting, you know, one final pullback to new lows that ends up being a buying opportunity. And so that's something that I'm always on the lookout for, is that, you know, a pullback down to this area, 1250, 1240 would be an excellent chance to get long, because I think sentiment has already gotten quite negative. So, but we need the dollar to turn down and for yields to turn down, really, for gold to work. And recently yields have been moving higher, and so that doesn't really bode well just yet for gold. But I think we'll have our chance to get long. And really anything over recent highs would make me very bullish on gold above 1310. I think that really paves the way for the start of a rally up to challenge these highs. The longer term pattern's been, as you mentioned, pretty, you know, right now we've been range bound for the last few years, but arguably a much bigger base in the making that could, you know, lead to
that measures some like type of a larger rally. That ascending triangle measures to about 1600. If we break out.
So this is the longer term, you know, trend from 2011, which you could argue we did see a minor breakout, but we haven't followed through. So it's been sideways, and so we need to see the move over to 1370, which, given how many people watch this, you know, we'll see exactly. I presented this at Stock Charts. You know, the website had their seminar, the conference out east in New York a couple months ago, and I presented this as being a very attractive idea, simply because of the degree of consolidation after this breakout, and I saw that the chart pattern is growing a little more constructive. But this really does depend on the dollar turning down sharply, and for the economy potentially to weaken in a way that yields would also start to pull back, and so that's going to be necessary, I think, for gold to work.
Okay, and does this pullback include indexes? You have any cycles or times that are saying that we could be getting close to something, or we're just going to blow to new all-time highs here?
No, I don't think we blow to new all-time highs. I'm a little more pessimistic, and I've been pretty bullish over the last month, but I think we're at a time when, you know, many people are looking at this time and the middle part of the month as being important for a few reasons, but you know, it really echoes what we've seen over the last couple months, and that's what's truly interesting about this market, is that when you take a look at how stocks have moved of late, we saw the peak in the middle part of March. We sold off into end of month. We bottomed out early April. We rallied till April 18th. We peaked out. We fell to early May. We peaked out in the middle part of May. We sold off to end of month. Now we've rallied into the middle part of June. You know, we've done that over the last few months already. Now we have evidence of exhaustion. DeMark-wise, based on one measure, the other will take another 4 days. I'm not confident that we break March highs in the S&P before we start to turn down. So I'm looking for a peak sometime in the next 3 to 5 days, based specifically on, you know, a couple different cycles, and also just given near-term overbought conditions. I think there's divergence that needs to be watched not only in the U.S. indices but also abroad, because Europe really has not been participating of late. I think that's a concern. You have the Nasdaq that's moved to new highs, but yet the S&P and the Dow haven't.
Yeah, have you ever seen
seasonality
that
typically?
Have you ever seen that much disparity, Mark, with the Nasdaq making new highs and the S&Ps being 100 handles off their high?
It happens over time.
I can't recall.
I mean, I think it's interesting. Yeah,
I can't recall a time.
It's an interesting market only because small caps have had a very healthy rally of late, and the IWM and everybody points to that as being very constructive. And the advanced decline is also at new all-time highs, and so that's it makes it tough to argue for a greater market peak just yet. You need to see some evidence of divergence, and you just haven't seen that. So I'm more calling for a short-term correction. I do think July could be interesting for those to study. What Putz wrote about eclipse cycles, and there should be some interesting things happening from the middle part of July into late July, which I think can be a pretty serious turning point for the market. And but I don't know that we're going to see any real damage done until you might rally into the fall and into September, October, and I expect that rally could happen on a lot weaker breadth and momentum, and maybe set up some of those divergences that could allow for a peak. But I see the market as still being pretty healthy based on longer. Can't be a real bear based on weekly, monthly trends of the S&P. Just going back, bear with me. Let me see my chart can load. So yeah, here's the longer term trend of the S&P. We haven't really seen any divergence. We do now have weekly TD sequential sells, and we're seeing DeMark sells now across many different indices on a weekly basis and on a monthly basis, and the dailies will be there within a few days. So
your first
turn
green
down
line,
sharply.
Your first green line above 2400, Mark. Your first green line, dotted line.
Yeah.
On your chart, it looks like a little bit above 2400, where your bars are up on top. Oh,
yeah, that's just a longer term. That's a TDST level based on the mark system.
Well, that's also fairly close to a C wave target if we peak here without making new highs, 24.5 or so.
Yeah, I mean that's really a first meaningful fib level from the entire move up since 2016. So I do think the next couple months can be rough, and I think that we can attempt to pull back from here. Even 5 to 10%. I don't see that as being unrealistic, but I think tech is going to stall out. I don't think the stocks can carry us up, and I don't like the patterns in indices like that, and technology being 25% of the market, 26%. I mean, it's just going to my thinking is you can start to really pull back here.
Yeah.
So transports haven't participated. Now we're coming into what's widely known as being really the worst part of the month, and the worst month of any midterm election year. So, June has been number 12 of 12, the worst month of the year. The average return is minus 1.7%, and since 1950, and the S&P has been up 2.5%. So there seems to be a perfect storm brewing for a potential peak in the next week, and we'll see if we get that.
Okay, I really appreciate the insight, especially that bottoms on the early part of the month, peaks in the middle part of the month. Any view on oil here, Mark? We had that washout from 72.80. You're looking for continuation of the trend, or may there be a buying situation setting up?
I think that is right. I think the longer term trends are still intact, but you did see a good degree of weakness, from the peaks that we saw in May. So I think you rally into the end of the month into early July, and potentially you can peak there again. I view, the short-term trend line was violated from the last few months, and many people will bring that up as being important, and it is. But I would argue that a move above 67 sets us up for a move back to challenge the low 70s, and that's probably a chance to sell into it, given the extent that momentum has started to shift from just mid-May. So I'm not a real longer-term oil bull. I think that it's right to be tactically positive here and really adding to longs as you start to move higher. But I would really look to trim longs in the low 70s. And energy as a sector really hasn't participated all that much to the degree that crude has moved, and that's been an ongoing concern for the oil bulls.
I found it interesting. I saw a tweet of yours late last week talking about the lack of volatility in crypto. So that means you're covering it, and it seemed to have been a harbinger for extreme volatility in crypto on a Sunday over a hack. So what are you looking at?
We've consistently seen some pretty outsized moves happening, during the weekends and most of the cryptocurrencies, which is sort of interesting. I mean, it seems like you sort of lollygag through the week, and then you get the big moves on the weekend. So we're certainly at interesting areas now. Bitcoin is arguably, we've really broken April lows, but we're not really accelerating lower. We're just sort of sitting there as of now. So this is a daily chart just of Bitcoin, which has been a little bit weaker than things like Ethereum, and I think it's going to be potentially still. I'm looking for a low, but I think it's really tough to argue we're there. So I was trying to play this from the long side up until this weekend, and I got stopped out, and so I'm sort of sitting on my hands and waiting for this to show me more signs. Either going lower over the next week would produce a buy for me, or evidence of this snapping back up above 7,100. So
thank God you're not a hold on for dear life hodl guy, and you had a stop in, and it's interesting to me that you're even trading crypto right now, Mark. That's interesting to me. So you think that besides price moves, you must be positive on blockchain and beginning to educate yourself in this new asset class?
Yeah, I think it's interesting. I think it's a couple things stand out to me, and one is that the entire world of people that are not affiliated with the blockchain, that haven't built the infrastructure, most of those people have been pretty bearish on cryptocurrencies. Either they don't understand it, the sentiment has been bearish, yet the banks are going full throttle towards this and opening up trading desks left and right, and the futures markets are expanding, and most countries in the world, like Japan and some other countries, are making major inroads towards allowing customers to buy things using Bitcoin Cash and Bitcoin, and that makes me have a lot of interest, because nobody else is interested and people are negative on it, yet now we're right back at April lows, and that sniffs of opportunity for me. It just does. I think that the banks wouldn't be going into this like they are just to save face. And I understand that sometimes they act because others do the same thing and they don't want to get caught behind the curve, but people have seriously invested some real time in studying this, and the correlation to equities really isn't all that positive, and it's pretty negative. So for me, as another something that I can trade, I mean, it's interesting, and there's a lot of volatility in it.
Yeah, a lot of volatility. And do you buy the correlation that Bitcoin crypto is kind of a feature of the animal spirits speculation being here, and we've seen a couple of moves in indexes be correlated where Bitcoin actually, or cryptos, led the way up or down?
Yeah, to some extent. I think, well, I don't know about the correlation. We did see times in early April and in, you know, mid-month where we peaked out and have been similar, and other times where it hasn't. I mean, people have talked about a lagging cycle of 40 days. I don't think there's the interest. I know probably 3 to 5 people that are involved, and the majority of people I know don't know about it. You know,
that's because you only know old people now, Mark.
That's right. That's a good point. Yeah, no, I'm getting old, and I don't know the. Oh yeah, me and my millennial friends all own it, and we love it. No, you're right. It's
the new
people are
new
conservative.
way.
They don't want to take the time to understand it, and I think that gives an advantage to somebody like myself that can trade it technically. And I don't mind if I'm wrong a few times, because when the trend finally starts to work, I'll be there and I'll own a lot of it. You know. So
Mark. So you want to show your website so people know how to reach you and possibly follow you, subscribe to you, etc.
Yeah. So I started up my own business 2 years ago called NewtonAdvisor.com. So for those that don't know, I used to be an equity options trader in Chicago. I worked with Morgan Stanley for a few years. I worked with Diamondback Capital.
Where do you live?
That ended back in 2011. So I live in Fairfield, Connecticut, but I commute down to the city probably once a week and do a lot of media there. And so I'm happy to give people a trial. And for anybody that mentions they listen to your call, Dale, I'm happy to knock off, 50% off the first month. But I cater to mostly institutions, but I wanted to open up my research to individuals as well. So individuals don't get the personalized customization like institutions do, but I basically try to write at least 2 notes every day, and I do a video every morning. I do conference calls. One of my own is going to happen tomorrow at 1 o'clock, and so go to NewtonAdvisor.com and see what we're doing. Happy to talk to you about what's going on here.
All right. Well, thank you, Mark. And I think there is a huge void for real good research and analysis in the crypto arena. A lot of people out there are, following, people that don't have the kind of technical background you do. So thanks very much for your time today, Mark. Some very insightful views like usual, and good hunting and after the Fed and the ECB and BOJ, and until the next time we speak.
My pleasure, Dale. It's always happy to be on your show. It's certainly a lot to look at. So I'll be on CNBC this Friday, I believe, at 2:30 for those that would like to check that out further. So
all right.
Thanks for having me on.
You're welcome. I'm expecting an 8x10 autographed glossy photo of you in the mail. So
I love the exposure, but they don't pay me, so I just do it to try to spread the gospel, just like you. So
thanks, Mark.
Enjoy your summer, and let's touch base again soon.
All right. That's Mark Newton, everybody. Thank him. My trading warrior brother, Mark Newton. You can find him on Twitter at Mark Newton. It'll come up. I think he has CMT after it. And
at
go
Mark
to his
Newton CMT. That's good.
Okay, and go to his website. And that's a wrap for us. Good luck with the Fed today, everybody. See you tomorrow. And most of all, don't just count your pips. Count your blessings. See everyone tomorrow. Adios.